And the last line in this section will be margin of safety. So this is a new concept that we haven't talked about last week. But basically, it's just the differences between break-even sales, the sales that you need to make in order to at least cover expenses, the differences between that and the expected sales or the current sales that your company made. So if your break-even sales was, if you calculate it based on contribution margin, at the end you figure out your break-even sales is $1,000, and currently your company is making $3,000 for this product, then your margin of safety is $2,000. Either current sales or expected sales. Okay, so margin of safety really is just any sales amount that you went above break-even sales. The differences portion, the $2,000, is what we call margin of safety. The reason why we call it safety is because this is like a deposit you make up front in the business, like a deposit for rainy days. If this season you're able to make above break-even sales $2,000, that means in the next season, in case the economy is not that well, you're not able to make $1,000, you only made $500. Next season, even though it's a minus 500 compared to break-even, but since last season you had 2,000 left, overall you're not getting operating losses if you average them out. Right? So this is just like a safety amount that you made up front. It's like a cushion of sales in case later seasons the business is not going that well, you still had earlier margin of safety stored up front. So you will not be getting losses if you average out total sales and profit. Yes. That $2,000 later at the end will be shipped to retained earnings, yes, because it's part of revenue. You're talking about year end will become retained earnings, yes. It could be months, it could be year. Usually we call it could be at least quarterly. Usually you may not be doing this analysis every single month, but it depends. If it's a newly started business, it could be monthly tracking the margin of safety. It could be also fulfilling quarterly reports for public companies, half-year reports or annual reports. But definitely annual reports, they need to calculate this. Okay, so margin of safety is just the amount differences between the break-even sales that we learned last week. Once you calculate this, compare this against the current sales or the expected sales in the future. Both of these, we call the differences margin of safety. Okay, so it's talking about the sales side, not on the profit side. Simply just the differences between expected sales and break-even sales, or the current sales the company has and break-even sales. As I said, think about the differences as a deposit that a company makes before. Just in case later on the season doesn't, the business doesn't look so well, you still have earlier margin of safety to cover this. So this problem here tells you that the break-even sales in events and units, remember the DJ services, we calculated 100 events to break even last Friday. So if the current season they were expecting to get 170 events in the beginning of the year, they did some research, they expect that right now the season is, the business is doing pretty good, they may be able to get 170 events from customers, then the difference is 70 events multiplied by each event's sales revenue to get this margin of safety in dollars. Okay, so we look at margin of safety in the perspective of sales revenue, not in profit side. So when we talk about margin of safety, usually it's the sales revenue differences, not the profit differences, because remember profit relates to the cost, relates to operating income. So usually when we talk about margin of safety, it's in the aspect of sales revenue.